In this week's video, we'll examine the question, can charts predict the future? Within the context of this week's Fed meeting and sharp reversal in stocks. Regular viewers have seen this slide before. We'll tie in what happened in the markets this week after the Fed announcement and before the Fed announcement, the concept of maximum flexibility. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Before we talk about how charts could have helped us before and after this week's Fed meeting, let's talk about what charts do well and what they don't do so well. There are literally billions of people around the globe that either directly or indirectly impact the financial markets and asset prices. We all have our own opinions about numerous inputs, and everything matters in the market. Some things are more important than others, but ultimately what drives asset prices is the net aggregate opinion of all the inputs. There's a subset of people here that are bearish. There's a subset of people here that are bullish. If the bulls have greater conviction than the bears, then the net aggregate opinion is positive or bullish. Charts allow us to monitor the net aggregate opinion. The expression, the market doesn't care what you think, is true. It doesn't care what I think. It's the net aggregate opinion that drives asset prices. This is what the stock market looks like when the net aggregate opinion of all the inputs is bearish. This is what it looks like when the net aggregate opinion or the conviction of the economic and stock market bulls is greater than the conviction of the stock market and economic bears. What the stock market does as a whole, or market participants, we're all making probabilistic forecasts about the future. You wouldn't buy a stock if you didn't think it was going to go up. You wouldn't short if you didn't think the market was going to go down. So we all have our own personal probabilistic forecasts. The net probabilistic forecast is shown in the chart here. At this point, the net probabilistic forecast is bearish, and at this point, the net probabilistic forecast is bullish. Before we tie these concepts into this week's Fed meeting and subsequent rally, it's important to emphasize that the chart is based on all the known information. While everything matters in the markets, the last few weeks, the most important thing has been the Federal Reserve, and we'll talk about how we know that at the end of the video. This is the stock market. This is the end of the rally off of the October low. For the most part, we have a net aggregate bullish opinion. What changed? On Monday, December 8th, an article was published in the Wall Street Journal that basically said there was a good chance that the Fed was going to remove considerable time from their statement. Stocks finished in the red on Monday, December 8th, and continued to decline heading into the Fed meeting. The Fed isn't the only reason for these declines, but it is the biggest reason, and again, we'll touch on that later. Now we're looking at a weekly chart of the S&P 500 here. This is as of Tuesday of this week, December 16th, before the Fed meeting. You can see here we have a full-bore bearish look, and on a weekly basis, the net aggregate opinion had flipped from positive or bullish to negative. What does history tell us about the need for flexibility when we get a look like this? This looks very, very similar to this. This is a full-bore bearish look, and this is a full-bore bearish look. Typically what we do as human beings, we look at this and we extrapolate. We assume that the market will continue in this direction. Well, history tells us that forecasting or extrapolating off of this chart heading into the Fed is dangerous. In this case, this type of profile did result in further declines. In this case, this type of profile did not. Something changed here and the market rallied. So the look of this chart on Tuesday, December 16th is based on the known information on Tuesday, December 16th. The market was expecting the Fed to have more of a hawkish tone and potentially remove the statement considerable time, which would have signaled that an interest rate hike was most likely coming sometime in the next 6 months. This is the look of the weekly chart on Tuesday. This is the look of the weekly chart on Thursday, December 18th. Full bore bearish look flipped back to a full bore bullish look. Why? The known inputs had changed. The Fed came out with a much more dovish or stock-friendly statement than the market expected. When the inputs changed or the knowns changed, the market changed its probabilistic forecast from a bearish forecast to a stock-friendly bullish forecast. This here speaks to the need for maximum flexibility, open-mindedness, and waking up every day with no bias. This chart here very easily could have looked like this. If the Fed removed considerable time, there was real risk in the markets here, and hence why we reduced exposure to stocks. We don't guess on Tuesday, December 16th that things will improve. We need to see evidence of improvement. The market's risk-reward profile is unfavorable here. The inputs and knowns change and it becomes favorable again from a probabilistic perspective. That flexibility tells you you have to be willing to cut risk on a Tuesday and add back to risk on a Wednesday, as we did after the Fed's statement. We also added on Thursday and Friday. One of the mistakes that we tend to make as human beings is we might decide in advance what's going to happen at the Fed meeting. It's obviously going to be bearish and stocks are going to fall. If we forecast and form an opinion about what's coming on Wednesday, it drags our ego into the process. We all want to be right. If our ego is involved, it becomes much, much harder to see the observable improvement and have the required flexibility to make adjustments to your portfolio as the observable evidence and risk-reward ratio improves. Therefore, what do charts do well and what do they not do so well? Can charts predict the future? The answer is mixed. It's yes and no. What charts can do, they allow us to see a probabilistic forecast of the net aggregate opinion of all market participants. When the slope of the line is up, it's telling us that the odds of good things happening are favorable. When the slope of the line is down, it's telling us that the net aggregate opinion is bearish and the odds are unfavorable. What the charts can't do, and it was made abundantly clear this week, charts cannot predict what new information is coming, or said another way, charts cannot predict what events will take place tomorrow. We had a bearish probabilistic forecast heading into the Fed. The chart and the probabilistic forecast and market participants can't predict what the Fed will do. Therefore, we have to remain flexible and open to charts and probabilistic forecasts that shift rapidly when the knowns shift rapidly, as they did Wednesday when the Fed released their statement. How do we know that, for the most part, this decline was as a result of fear of the Fed potentially raising interest rates? We know that because as soon as the Fed meeting was over and that fear was taken off the table, the stock market rallied hard. Before we look at some forecasting tools for the present day market in December 2014, let's look at another example of how forecasting or extrapolating can burn you when you're using charts. This is a bearish look here. This is almost a look of a new bear market. The slope of the 200-day is rolling over. Price is below the 200-day. This is our death cross. The slope of the 50-day is down and price is below both. That's a full-bore bearish look telling us that the intermediate term trend in blue and the longer term trend in red are rolling over in a bearish manner. This is a very similar look here. If we look at this and forecast that a bear market is coming, it's going to be very, very difficult to maintain the flexibility that we need to see if the inputs change. Here, 2001, we do get a bearish outcome. In this case, we don't. The knowns changed in 2011 here when the ECB started talking about bailing out the banks in Europe. Notice the difference between the two. The 50-day here never really turns back up in any significant manner. Not the case here. The evidence on the chart, I can see this. The 50-day starts to turn up, and after that, good things happen. It's very, very difficult to see this and react if we forecast and decide in advance what's going to happen. We can easily see how these statements here applied to what happened this week. Before the Fed, we had a bearish probabilistic forecast. The inputs changed, and the probabilistic forecast or net aggregate opinion of market participants changed as well. Now we're shifting gears to the present day market and what we're seeing in 2014. This is risk on versus risk off, the stock market or the S&P 500 relative to a basket of diversified bonds or the AGG ETF. You can see a lot of confusion here, a lot of whipsawing going on. That's not really that unusual when the Fed is getting ready potentially to change policy. Market participants can't decide here if they want to be bullish and own stocks or be bearish and own more deflation-friendly bonds. Point of the exercise here, you can see the potential for a bullish inverse head and shoulders pattern that's taking place on this chart. Potential. We have to break this neckline here for this pattern to really come into play. So this chart still has some work to do, which speaks to keeping an open mind. We don't want to have a bias to the upside because of this chart. If we want to produce a back of the envelope probabilistic forecast or target out of this pattern, you take the distance from the bottom of the head back to the neckline, and then you extrapolate from there. This move here should be very, very similar probabilistically. If the pattern plays out, this move should be similar to this move here. If we break out above the neckline on this ratio in the coming weeks, the probability of good things happening in the stock market relative to the bond market will have improved or increased. We have a similar confused look on the broad NYSE Composite Index. You can see the stock market as a whole made no progress point to point for 6 months. We were at the exact same point in October that we were in April of this year. This too has the potential for a bullish breakout. When the neckline slopes down like this, it's a lower probability pattern. It's also a lower probability pattern when the right shoulder is lower than the left shoulder. So we have to keep those caveats in mind. If this breaks out above the neckline, which it has not done yet, our back of the envelope forecast would be taking this distance here. So if we break out here, the probability of very good things happening will have increased. Does it mean good things will happen? No, that's why we're using the term probability. If you know technical analysis, you know that when charts line up on multiple time frames, that also speaks to improving probabilities of what you're seeing. This is the long-term breakout of the NYSE composite. This is 2007, bullish breakout, what appears to be a successful retest here. And you can see here our inverse head and shoulders pattern. There's the left shoulder right here. Here's the head, and here's the right shoulder forming. If we can exceed this high here, this is bullish, and this is bullish. What's bearish is that we have not made a new high in some time. So we'll keep an open mind. We'll learn something either way. If we end up in this territory here and break this level here, that would be bearish. We have similar price action on the weekly chart of small caps IWM, but somewhat of a mixed bag. If this is indeed our neckline, it's sloping down. That tends to say it's a lower probability pattern. The good news would be if this is my right shoulder, typically when your right shoulder is much, much smaller and doesn't go down as far as the left shoulder, that's a good sign. So we'll just have to see what happens. It appears as if this may have already broken out if this is indeed our neckline. We'll keep an open mind. The odds of this pattern playing out will increase if we can take out this high that was made earlier in the year on a weekly closing basis on IWM small caps. Remember last week we used this chart of the VIX to help us say that the probability of reversal coming was improving. Now what we have is a lower weekly high in the VIX. Lower weekly high, good things happen in the stock market. Lower weekly high after a spike, good things happen. Lower weekly high after a spike, good things happen. Lower weekly high after a spike, good things happen. Like every chart, this speaks to probabilities. If you're a stock market bear, you'd love to see the VIX close above 31 and change next week. This is a weekly chart of the stock market relative to intermediate term treasuries, or the IEF ETF, as of 2:24 p.m. on Friday, December 19th. What we have here is exactly what happened this week. This tail on this candlestick tells us that earlier in the week, fear was ruling the day and bonds were outperforming stocks. We had a sharp intra-week reversal in sentiment after the Fed meeting. This candle is engulfing this candle here, and we had a bullish finish. Typically, when you see something like that, it's a good sign. You can see we're also trying to complete a bullish moving average crossover here. So this chart too speaks to much, much better probabilities than we had last week. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.